Hello everyone, welcome to KPMG's podcast to discuss ASU 2013-10. My name is Jack Pohlman and I'm a Senior Manager in KPMG's Department of Professional Practice. This podcast was recorded on November 6, 2013. Okay, we can cover ASU 2013-10, which is the inclusion of the Fed funds effective swap rate as a benchmark interest rate for hedge accounting purposes. The Fed funds rate is also known as the overnight index swap rate, or as you may know it, OIS. Now I realize that not everybody deals with derivatives regularly. So let's just go over a couple of quick touch points. First, derivatives are recorded on the balance sheet at fair value. Their changes in fair value are reported in earnings. Now since these instruments change in value quite quickly sometimes, they can interject earnings volatility into the company's financial statements. Now, if you were using derivatives to speculate, it'd probably be fair to show that earnings volatility. But if you were using derivatives to manage risk, I would imagine in that case you'd want your financial statements to reflect that risk reduction, and that's where hedge accounting comes in. Hedge accounting can do exactly that, mitigate the earnings volatility that would otherwise be caused by derivatives. However, many conditions need to be met. For example, under previous rules, if you were hedging interest rates, hedge accounting was only allowed if you're hedging a so-called benchmark interest rate. So what is a benchmark interest rate? Well, it's a rate that is, in theory, free of credit risk. Now just a little bit more background. If you think back to before the financial crisis of 2008, just about everybody used LIBOR to value their derivatives, and the crisis changed that. Today, if you went into a derivative, you can expect that the counterparty will demand collateral. In fact, you may have on a daily basis to top off your collateral at 100%. So for example, let's say you and I enter into a derivative. At the end of the day today, we determine that the derivative is in a $100 gain position for you, and that would be a $100 liability for me. And that would mean I would need to post $100 as collateral. So since you have my collateral, the credit risk is very low. Your credit risk exposure to me is very small. So with your credit risk being low, that emphasizes the need for a discount rate that contains a near zero credit risk when you value your derivatives. Well, before the crisis, that used to be LIBOR, but now LIBOR has become more erratic and the market has moved to use the Fed funds rate to do that discounting. So what does this mean for the accounting? Well, let's step through an easy example. Let's say you're a manufacturer and you issue a fixed rate bond. You hedge that with an interest rate swap. Presumably, that interest rate swap will be collateralized, and we just discussed some of the reasons why a collateralized derivative would require the Fed funds rate as a discount rate. Intuitively, you may want to use that Fed funds rate to calculate the change in the value on your hedge instrument for hedge accounting purposes. But prior to ASU 2013-10, you couldn't. The literature said you must use a benchmark interest rate, which was the U.S. Treasury rate or the LIBOR rate. And so what that means is, even if your interest rate swap and your hedge instrument are perfectly matched up, you're going to have some ineffectiveness, only because you are determining the fair value of the derivative using one rate and the change in fair value of the hedged item using another. So let's look at a graphic for an example. What we have here in these three boxes represent the absolute change in fair value. So the first box on the left is reflective of the change in fair value of the hedging instrument. Now let's say that is used using the Fed funds rate as a discount rate. And now moving over to the right are the hedged item. It's actually the same hedged item. However, the middle box reflects the change in fair value of the hedged item if the Fed funds rate was used as a discount factor. And the one next to that to the right is a box for the same hedged item using the LIBOR rate as a discount rate. And so you can see the black line that cuts across the slide horizontally. And if you look at that, you'll see that when we calculate the change in fair value, the hedged item using the Fed funds rate, it is much closer to the actual change in the hedging instrument than it would be had you used LIBOR as a discounting factor. In the bracket here, I'm showing what the ineffectiveness would be. See, under LIBOR, there's incremental ineffectiveness that really does not represent the economics. So in summary, ASU 2013-10 allows companies to use the Fed funds rate as a benchmark interest rate. Another decision that was made as part of this ASU was to strike certain language that's been there in the literature in regards to requiring a company to use the same benchmark rate for similar hedges. The effective date here is upon issuance on July 17th. The transition is prospective, and it would be applicable only to new hedges or existing hedging relationships that were de-designated and then redesignated. We cannot go back and change the hedge documentation because there are rules about contemporaneous hedge documentation, so we can't go back retrospectively. That concludes KPMG's podcast. You can find more information on KPMG's Financial Reporting Network website, including KPMG's defining issues on this topic. Thanks for your time and listening to this podcast.